Welcome, traders, to the world of proprietary trading. If you're ready to master the markets, sharpen your skills, and take your trading game to the next level, then you're in the right place. In this journey, we'll break down what it truly takes to succeed in the world of high-performance trading. Whether you're new to trading or have been in the game for a while, One Good Trade by Mike Bellafiore is packed with real-world insights and proven strategies to help you make that one good trade that changes everything. In this book, you'll learn everything from how to identify opportunities, build discipline, and deal with the ups and downs of trading, to how to create a mindset that keeps you on track even when the market goes against you. Before we dive into all the actionable knowledge packed in these pages, if you love these insights and want more content like this, make sure to hit that like button, subscribe to the channel, and share this video with others who are ready to trade smarter, not harder. Let's get started with the first chapter of One Good Trade. You don't want to miss this. Chapter 1. These guys are good. Welcome to the world of proprietary trading, where the stakes are high and the rewards can be even higher. In this chapter, we dive into the heart of the trading world, where firms don't just rely on software or algorithms, they rely on their traders. Let's break it down. A firm's greatest asset, its traders. In proprietary trading, the real asset of any firm is not its capital or technology, it's the traders themselves. These traders are the driving force behind the firm's success. They are the ones who make the decisions, take the risks, and ultimately generate profits. Bellafiore emphasizes that these traders are highly skilled professionals who don't just react to the market, they actively shape the outcomes. Unlike traditional investment firms where long-term strategies are often key, proprietary trading firms thrive on quick decision-making and the ability to adapt to the market in real time. And guess what? Great traders are made, not born. It's all about creating an environment where top talent can grow and flourish. Building from your positive base. Bellafiore talks about the importance of building your career from a positive base. This means when you start trading, focus on the fundamentals. Build your skills and confidence before attempting bigger trades. Every trader must establish a foundation of solid habits and learn how to read the market accurately. Successful traders don't just rush into high-stakes situations. They learn the core principles, practice their techniques, and gradually increase their trading size as they build confidence and experience. The foundation they lay early on is crucial to their long-term success. The role of the trader, beyond numbers. In the world of proprietary trading, numbers tell a story, but it's the human element that makes the difference. The best traders are not just smart with numbers, they're also emotionally intelligent, capable of managing their reactions to wins, losses, and market movements. Bellafiore emphasizes that, in a proprietary firm, traders are not treated like just a cog in a machine. They are given the space to make decisions, experiment with strategies, and even fail, all in the pursuit of growth. Failure is part of the journey, and the key is learning from each misstep, not fearing it. Let's take a moment to reflect on what we've learned from this chapter. 1. Traders are a firm's most valuable asset. The true strength of a proprietary trading firm lies in its people, the traders themselves. 2. Build your career on a positive foundation by mastering the fundamentals and growing your skills before making bigger moves. 3. Emotion and intuition are just as important as technical skills in proprietary trading. A trader's ability to manage emotions and make decisions quickly can be the difference between success and failure. Chapter 2. One Good Trade. Let's break down what you need to know to succeed as a trader, and not just an investor. Defining a bad sale. One of the most important lessons for any trader is learning to define what makes a bad sale. It's not just about making money, it's about knowing when you're on the wrong side of the trade. A bad sale happens when your decision is driven by emotion rather than a clear trading plan. It's when you hold on to a losing position because of pride or the belief that the market will turn around, even when the numbers are telling you otherwise. Bellafiore stresses that cutting your losses early is one of the most important skills a trader can develop. Bad trades happen, but it's how you respond to them that separates the great traders from the average ones. You are a trader, not an investor. A common misconception among new traders is that trading is just like investing. Trading is not investing, and it's crucial to understand the difference. Traders make quick decisions and look for opportunities in the short term, while investors are focused on the long-term potential of a stock or asset. As a trader, your job is to capitalize on short-term movements in the market. Bellafiore emphasizes that flexibility and quick action are key. Trading requires you to be reactive to the market, while investing relies on patience and waiting for long-term growth. Traders must constantly evaluate the present situation, not just the future. The fundamentals: proper preparation, hard work, patience. Great trading starts with mastering the fundamentals. According to Bellafiore, proper preparation is crucial before each trade. You need to have a detailed plan and an understanding of the market conditions. But preparation alone won't get you far. Hard work and patience are just as important. Trading isn't easy. It requires hours of practice, research, and analysis. There are no shortcuts. You can't rely on luck to succeed. Hard work is what truly pays off in the long run. And along with that, patience is key. Don't rush into trades just to make something happen. The best trades often come when you wait for the right opportunity. A detailed plan before every trade. Every successful trade begins with a solid plan. Bellafiore stresses that having a detailed plan is not optional. It's a necessity. Before you even place a trade, you should know why you're making that trade, where you're entering, where you're exiting, and how much capital you're willing to risk. A clear plan will help you stay disciplined and not be swayed by the emotions that come with market fluctuations. By defining your risk management strategies beforehand, you ensure that you don't make impulsive decisions that could result in unnecessary losses. Discipline and communication. Discipline is at the heart of successful trading. A trader who lacks discipline will likely struggle because trading is not just about technical knowledge. It's about sticking to your plan, no matter what the market throws at you. Bellafiore emphasizes the importance of following through with your strategy, even when it's difficult. And don't forget communication. In a proprietary trading environment, traders constantly communicate with one another. Whether it's asking for advice, discussing strategies, or reviewing trades, communication helps traders learn and improve their skills faster. Replaying important trades. One of the most effective ways to learn is by replaying important trades. Bellafiore suggests that traders regularly look back at their successful and unsuccessful trades to analyze their decision-making. What went right? What went wrong? By replaying these trades, you gain insight into your trading style and learn how to make better decisions in the future. Moneymaker's one good trade. In the world of trading, it's often not about having a lot of trades, but rather one good trade that makes all the difference. Moneymaker, a reference to the famous trader in Bellafiore's firm, is someone who focuses on quality over quantity. He isn't chasing profits with every move. Instead, he's waiting for the perfect setup, the one trade that aligns with his strategic plan. Bellafiore shares that successful traders focus on finding these one good trade moments, rather than trying to be involved in every market move. The goal is not to make money with every trade, but to maximize profits when the conditions are right. Let's take a moment to reflect on what we've learned from this chapter. 1. Defining a bad sale is critical for cutting losses early and minimizing damage. Don't hold on to losing positions out of emotion. 2. Trading is not investing. It's about reacting to short-term market movements and staying agile. 3. Proper preparation, hard work, and patience are the keys to successful trading. There are no shortcuts. 4. Always go into every trade with a detailed plan to manage risks and ensure discipline. 5. Learn from past trades by replaying and analyzing them to improve your future decision-making. 6. Focus on one good trade. It's about quality, not quantity. Chapter 3, A Good Fit. Welcome to Chapter 3 of One Good Trade, where we dive into one of the most crucial aspects of proprietary trading: finding the right traders for the job. The success of a trading firm is built on its traders. And in this chapter, Bellafiore discusses how firms recruit and identify those who are most likely to thrive in this high-pressure environment. Who gets hired? Let's start by exploring who gets hired at a trading firm. In the world of proprietary trading, hiring isn't just about finding someone who's a math whiz or has an extensive background in finance. The real focus is on identifying individuals who possess the right mindset for trading. It's not just about skills. It's about personality and how someone reacts under pressure. Bellafiore explains that resilience, the ability to learn quickly, and having a strong work ethic are all qualities firms look for. A successful trader must be someone who can deal with failure and come back stronger each time. This is because trading is often a game of ups and downs, and only those who can adapt and remain focused on the big picture are likely to succeed. The recruitment process. Now let's look at the recruitment process. It's not a one-step process. Bellafiore outlines that firms typically go through a multi-stage interview process, where candidates are tested on technical skills, problem-solving abilities, and even their ability to perform under stressful conditions. The key here is that traders aren't chosen based solely on experience or education. Instead, it's about the intangible qualities they bring to the table, traits that will help them thrive in a fast-paced, ever-changing environment. Firms often place candidates in real-world trading simulations to test their reactions to live market conditions. This helps identify if they have the ability to make decisions quickly, manage risk, and maintain their composure when the pressure is on. Can a firm always spot the next great trader? Now, Bellafiore poses an interesting question. Can a firm always spot the next great trader? The answer, unfortunately, is no. While firms can use their experience and hiring process to predict potential, there is still a degree of uncertainty. The nature of trading is unpredictable. Traders evolve, learn, and adapt over time, and sometimes, even the best recruits may not succeed. Factors like market conditions, personal motivation, and even luck can impact a trader's success. However, great firms will provide the tools and environment that give traders the best chance to succeed. But even with that, there's no guarantee. That's why continuous development and support are key to fostering great traders. The pros and cons of recruiting experienced traders. Bellafiore also delves into the pros and cons of hiring experienced traders. The advantage of hiring someone with experience is obvious. They bring knowledge and expertise to the table. They're already familiar with market dynamics, and they understand how to navigate risks. However, the downside is that experienced traders often come with bad habits. They may be set in their ways and find it difficult to adapt to a new trading environment or different trading strategies. They might also have a fixed mindset, making it harder for them to grow and develop in a proprietary trading firm where flexibility and constant learning are key. Bellafiore suggests that firms need to be careful when hiring experienced traders and ensure they fit into the company culture and are open to learning new techniques. A highly experienced trader can be a valuable asset, but only if they're willing to adapt and embrace the firm's training methods and strategies. A good fit for the trader. Now let's flip the script and look at what makes a good fit for the trader. It's not just about the firm choosing the right candidate. The candidate needs to evaluate if the firm is the right fit for them too. Bellafiore stresses that the right environment is crucial for a trader's success. A good trading firm provides more than just capital and technology. They create a supportive culture that encourages collaboration, learning, and personal growth. A good fit means finding a firm that aligns with your trading philosophy and allows you to thrive under their framework. If a trader's values and approach clash with the firm's, it's likely to result in frustration and failure. The best traders are those who find a firm that nurtures their talents and provides them with the resources they need to grow. A good home. Lastly, Bellafiore explains that the best trading firms aren't just about making money. They provide a good home for their traders. A good home means a place where traders feel supported, can learn from their mistakes, and have the resources they need to continually improve. The best firms offer a sense of community. They provide mentorship, create an environment where open communication thrives, and offer a platform for personal development. This kind of environment enables traders to not only succeed, but also to grow into their full potential. Let's take a moment to reflect on what we've learned from this chapter. 1. Successful traders are chosen based on mindset, resilience, and work ethic, not just experience or education. 2. The recruitment process is rigorous, with a focus on testing candidates in real-world situations and under pressure. 3. Not all great traders can be predicted, as the market is unpredictable and many factors contribute to success. 4. Experienced traders bring valuable knowledge, but may also carry bad habits or a fixed mindset. 5. A good fit for a trader means finding a firm that aligns with your trading philosophy and culture. 6. A good home for a trader includes a supportive environment that fosters continuous learning and growth. Welcome to Chapter 4 of One Good Trade. In this chapter, Mike Bellafiore introduces us to the Pyramid of Success, a powerful concept that lays out the building blocks for becoming a consistently profitable trader. Let's break it down and look at each piece of this pyramid and how it can set you on the path to success in trading. 1. First, be unoriginal. This might sound surprising at first, but being unoriginal is the first step to success. Bellafiore explains that in the beginning, it's crucial to follow a proven strategy rather than trying to reinvent the wheel. As a new trader, trying to come up with your own methods can lead to unnecessary risks and mistakes. Instead, model yourself after those who are successful. Study their strategies, understand their approach, and replicate what works. Once you build a solid foundation and gain experience, you'll have the knowledge and confidence to start innovating. But in the beginning, it's about sticking to what's proven and following a process. 2. Survive the learning curve. Next, Bellafiore talks about surviving the learning curve, and it's no secret that this part of the journey can be brutal. Every trader will face a period where they feel lost or frustrated, and mistakes seem inevitable. The key here is perseverance. You're going to face challenges, setbacks, and a lot of learning along the way, but the traders who succeed are the ones who stick with it through the tough times. The learning curve isn't about avoiding failure. It's about embracing it as part of the process and using those failures to become a better trader. Focus on learning, adjusting, and improving every day, and soon enough, the learning curve won't feel so steep. Focus on improving every day. One of the most powerful principles in this chapter is the idea of improving every single day. Bellafiore emphasizes that to be successful, you have to commit to continuous growth and development. Trading isn't something you can master overnight, and it's not just about making big wins. It's about small, consistent improvements. This means reviewing your trades, understanding what worked and what didn't, and making small adjustments to your strategy. Whether it's refining your risk management, tweaking your entry points, or getting better at reading the market, the goal is to get just a little bit better each day. By doing this, over time, you'll see substantial progress. 4. Ask thoughtful questions. Finally, Bellafiore encourages traders to ask thoughtful questions. Great traders don't just take everything at face value. They're always questioning, learning, and seeking deeper understanding. Asking the right questions helps you gain clarity and learn from your mistakes and successes alike. Instead of asking things like, "Why did I lose money on this trade?" Ask more thoughtful questions, like, "What was my reasoning behind this trade? Did I follow my plan? And what could I have done differently?" By asking insightful questions, you'll be able to dissect each trade more effectively and accelerate your learning process. In this section, we'll dive even deeper into talking shop, developing a daily work plan, bouncing back from defeat, eliminating mistakes, and respecting the markets. Let's break them down. 1. Talk shop. Talking shop is more than just casual conversation. It's about engaging in meaningful discussions with others who understand the intricacies of trading. Bellafiore emphasizes that one of the best ways to improve is to collaborate and share insights. The experience of others can offer you fresh perspectives and help you avoid costly mistakes. It's about creating an environment where you can exchange ideas, ask questions, and continue learning from the collective wisdom of the trading community. Trading isn't a solitary journey, it's a collaborative one. So, engage with peers, mentors, and other traders, and use these conversations to elevate your understanding of the market and refine your strategies. 2. Develop a daily work plan. A daily work plan is essential for keeping you focused and structured. Bellafiore stresses that successful traders don't leave their day to chance. Every day, you should have a clear set of goals and tasks that will keep you on track. This includes preparing for the market, setting aside time for trade review, and ensuring that you stay disciplined in your risk management. Your work plan should also include time for reflection, going over your past trades to identify mistakes and areas for improvement. A daily work plan helps you prioritize the right activities and avoids distractions that could affect your performance. It's your roadmap for staying consistent and organized throughout your trading day. 3. Bounce back from defeat. Bouncing back from defeat is a critical skill in trading. We all face losses. It's part of the game. But Bellafiore explains that the most successful traders are those who don't let losses define them. The key is mental resilience. When you face a loss, instead of getting frustrated or emotionally charged, take time to assess the situation. Was the trade based on a sound strategy? Did you follow your plan, or did emotions take over? Learning from defeat is essential for growth. Don't just move on to the next trade without understanding what went wrong. By bouncing back from defeats with a clear mindset and a commitment to learning, you'll be better prepared for the next challenge the market presents. Harp 4. Eliminate your mistakes. In this section, Bellafiore emphasizes the importance of eliminating your mistakes and learning from them. Successful traders are always reflecting on their decisions, particularly the ones that didn't go as planned. Every mistake, whether it's taking a position too early, not adhering to your stop loss, or reacting emotionally, is an opportunity to improve. Bellafiore encourages traders to track their mistakes, identify patterns, and then actively work on eliminating them. This process may take time, but is the key to reducing unnecessary errors and becoming a more disciplined trader. Over time, eliminating these mistakes will help you develop stronger decision-making skills and a more robust trading strategy. 5. Respect the markets. Finally, respecting the markets is perhaps one of the most critical pieces of advice in this chapter. Bellafiore stresses that the market is unpredictable, and no matter how much knowledge or experience you have, there will always be uncertainty. Successful traders are those who approach the market with humility, understanding that they cannot control it. Respecting the markets means acknowledging its power, being prepared for its unpredictability, and accepting that not every trade will be profitable. It's about having the discipline to stick to your risk management rules, maintain emotional balance, and never get overly confident or complacent. The market demands respect. If you fail to give it the respect it deserves, it will remind you of its unpredictability through losses. Now, we're diving into more critical aspects of becoming a successful trader. 1. Master basic trading plays. Bellafiore emphasizes the importance of mastering the basics before diving into more advanced strategies. Many traders, especially beginners, want to jump straight into complex techniques, but Bellafiore argues that solid fundamentals are key to long-term success. By mastering basic trading plays, such as simple entry and exit strategies, understanding support and resistance levels, and using risk management techniques, you set a strong foundation for yourself. Once you've perfected these basic skills, you'll be able to navigate the markets with more confidence and start building on more complex strategies. Mastering the basics gives you a solid framework, and once you have that, everything else becomes easier to grasp. 2. Learn to execute orders quickly. In trading, timing is everything. Bellafiore stresses that you need to learn to execute orders quickly. The market moves fast, and being able to place trades quickly and efficiently is crucial. Whether it's entering a position, setting stop losses, or locking in profits, executing orders promptly can make the difference between a profitable trade and a missed opportunity. Bellafiore recommends that traders practice their order execution, familiarizing themselves with their trading platform and tools. Speed and precision in execution will help you stay ahead in the fast-paced trading environment, ensuring that you're not left behind when an opportunity arises. 3. Fine-tune your focus. Traders need laser-sharp focus to succeed, and that's exactly what Bellafiore discusses next. The ability to fine-tune your focus is vital because the market can throw a lot of information at you all at once. From chart patterns to breaking news to social media chatter, it's easy to get distracted. Bellafiore advises traders to be selective with their focus and hone in on what matters most. This means narrowing down the indicators, setups, and strategies that align with your trading plan, instead of getting bogged down by every small fluctuation in the market. Staying focused helps you avoid emotional trading, overtrading, and making impulsive decisions. By learning to concentrate on your core strategy, you'll increase your chances of success. Hack 4. Control your emotions. One of the biggest challenges for traders is controlling their emotions. Bellafiore makes it clear that emotions like fear, greed, and frustration can cloud judgment and lead to poor decision-making. Whether you're chasing a losing trade or feeling overly confident after a win, your emotions can quickly spiral out of control. The key to controlling your emotions is self-awareness. Bellafiore suggests taking regular breaks, sticking to your trading plan, and practicing mindfulness techniques to maintain a clear, focused mindset. Emotional discipline is crucial because the market will test your patience, and only by controlling your emotions can you make logical, well-thought-out decisions. Mastering emotional control is often the difference between a good trader and a great trader. 5. The good news. And here comes the good news. According to Bellafiore, you don't have to be perfect to succeed. You don't need to nail every single trade or make no mistakes at all. The key to success in trading is consistency. If you can be consistent in your approach, mastering the basics, executing orders efficiently, staying focused, and controlling your emotions, you will naturally see improvements in your trading performance. Bellafiore reassures us that even the best traders face setbacks, but their resilience, focus, and discipline are what help them succeed in the long run. The good news is that if you can apply these principles day in and day out, you will steadily improve and eventually reach the level of consistent profitability. Welcome to Chapter 5 of One Good Trade. In this chapter, Bellafiore dives into one of the most important aspects of trading: why traders fail. Understanding these pitfalls can help you avoid the mistakes that hold many traders back from achieving consistent success. Let's explore the key reasons why traders fail and how you can sidestep them. Top 1. They don't listen to the market. One of the first reasons traders fail is that they don't listen to the market. Now, what does this mean? Well, many traders are so focused on their own ideas or predictions that they ignore the signals the market is giving them. Bellafiore explains that successful traders are those who can tune into the market's rhythm. They pay attention to what the market is actually doing, not just what they want it to do. This means staying humble, avoiding confirmation bias, and constantly adapting your strategy based on real-time data and price movements. Listening to the market requires being open-minded and flexible, rather than stubbornly holding on to a predetermined belief or trade idea. If the market tells you something's not working, you need to be willing to pivot. Hash 2. They don't love trading. Another major reason traders fail is because they don't love trading. Bellafiore stresses that trading is hard, and it requires dedication, passion, and a strong work ethic. If you don't truly love the process, it will be hard to put in the hours of preparation, learning, and emotional resilience required to succeed. Successful traders enjoy the challenge. They're excited by the analysis, strategy development, and the learning process, even when they face setbacks. If trading feels like a chore or just a way to make money, it will become difficult to stick with it during tough times. The key to success is having a passion for the craft, continuously improving, and finding fulfillment in the journey itself. Love for trading keeps you engaged, focused, and willing to overcome the inevitable challenges. 3. They don't have a plan. Another common mistake is that traders fail to create a clear, structured plan. Bellafiore talks about the importance of having a roadmap for every trade you make. This means knowing your entry points, exit points, stop-loss levels, and most importantly, the strategy behind the trade. Without a solid plan, traders tend to make impulsive decisions driven by emotion rather than by reason and analysis. It's easy to get caught up in the excitement of the market, but without a well-thought-out plan, you're more likely to make mistakes that could have been avoided. Bellafiore emphasizes that a trading plan doesn't just help with decision-making. It also serves as a safety net when emotions start running high. 4. They don't follow their plan. Even if traders do have a plan, many still fail because they don't follow it. Bellafiore highlights that discipline is one of the most important factors in successful trading. Having a plan is only half the battle. Executing it consistently is the other half. Many traders let emotions like fear or greed interfere with their ability to stick to their plan. For example, when a trade isn't going well, a trader may panic and exit too early, breaking their own rules. Or they may hold onto a losing trade too long because they hope the market will turn around. The key to success is sticking to your plan, even when it's tough. The more you follow your plan, the more you build discipline and consistency, which ultimately leads to better long-term results. 5. They don't keep a journal. Another reason traders fail is because they don't keep a trading journal. Bellafiore stresses the importance of tracking every trade you make. A trading journal is more than just a record of your wins and losses. It's an essential tool for improving your performance. By reviewing your trades, you can identify patterns, spot mistakes, and figure out what's working and what's not. It's the best way to learn from your experiences and refine your strategies. Bellafiore recommends being honest with yourself in your journal. Don't just focus on the outcome of the trade, but also the process behind it, your reasoning, your emotions, and your execution. Keeping a detailed journal is a powerful way to accelerate your learning and growth as a trader. 6. They don't manage risk. The final reason traders fail is that they don't manage risk properly. Bellafiore emphasizes that no matter how good your strategy is, risk management is the foundation of successful trading. If you're not managing risk properly, you could lose everything in just one bad trade. Risk management includes setting proper stop losses, knowing how much of your capital you're willing to risk per trade, and ensuring you don't over-leverage your positions. Bellafiore advises that successful traders have a strong risk management plan in place to protect themselves from significant losses. Without it, your gains can quickly disappear, and you'll find yourself making decisions out of desperation instead of strategy. Bellafiore uncovers more reasons why traders fail. Let's break them down to understand what holds traders back and how you can avoid these mistakes. 1. They can't hit stocks that trade against them. One of the major reasons traders fail is their inability to hit stocks that trade against them. This happens when a trader is too attached to a position, unable to accept when the market moves in the opposite direction. Bellafiore explains that successful traders are able to cut their losses quickly and not get emotionally attached to their trades. When a stock is going against you, it's crucial to take action and either reduce your position or exit altogether. By holding on to a losing position out of stubbornness, you increase the risk of bigger losses. Hitting stocks that trade against you is about cutting your losses early without hesitation and moving on to the next opportunity. Remember, small losses are part of the game. It's how you manage them that makes all the difference. 2. Smiling back to Hong Kong. The next concept Bellafiore touches on is a little bit more abstract. He calls it the smiley, and talks about it with a reference to smiling back to Hong Kong. This metaphor is all about emotional resilience. After a win or a loss, it's important to keep your emotions in check. A trader might become overly confident after a series of wins, or too discouraged after a loss. The smiley refers to maintaining emotional balance and staying humble no matter what. Bellafiore emphasizes that successful traders are able to celebrate their wins without getting cocky and learn from their losses without getting down on themselves. The key is maintaining emotional equilibrium, keeping your focus on long-term growth, and not letting temporary outcomes, good or bad, affect your trading mindset. 3. They have unrealistic expectations. Another reason traders fail is that they often have unrealistic expectations. Many new traders enter the market with the hope of making a fortune quickly. However, Bellafiore stresses that trading is not a get-rich-quick endeavor. The path to success in trading is gradual, requiring constant learning, patience, and discipline. Expecting to make large profits without putting in the necessary time and effort is a recipe for failure. It's essential to approach trading with realistic goals. Understand that the journey involves both wins and losses, and that long-term consistency is what ultimately leads to success. Bellafiore advises setting measurable, attainable goals that are aligned with your current skill level and resources, and adjusting them as you improve. Realistic expectations set you up for a sustainable and rewarding trading career. 4. They'd rather be right than make money. A common pitfall among traders is the tendency to prioritize being right over making money. Bellafiore notes that some traders are more focused on proving their predictions correct than on making a profitable trade. This mindset can be detrimental because it leads traders to hold on to losing positions in an attempt to prove themselves right rather than cutting losses and moving on. The market doesn't care about being right. It only cares about profitability. Bellafiore highlights that successful traders focus on being profitable rather than being right. This means accepting that you won't always make the perfect call, but as long as you are consistent and adaptable, you can still come out ahead in the long run. It's all about making money through smart, disciplined decisions, not through ego or proving a point. 5. Don't forget, you're a trader, not an investor. Finally, Bellafiore reminds traders of a key concept. You're a trader, not an investor. This is a critical distinction. While investors tend to take long-term positions based on fundamental analysis, traders are focused on short-term price movements, technical analysis, and capitalizing on market volatility. If you're a trader, you need to understand the difference between the two and avoid confusing the two mindsets. Traders are typically more concerned with short-term gains and risk management, while investors are focused on long-term growth. Bellafiore emphasizes that successful traders approach the market with a short-term focus, using technical indicators and momentum to guide their trades. If you start thinking like an investor, you may start holding on to positions for too long or ignoring important signals that could help you cut your losses quickly. Be clear about your role in the market. If you're a trader, act like one. Welcome to Chapter 6 of One Good Trade. In this chapter, Bellafiore delves into the mindset required to navigate the ups and downs of trading. It's all about resilience, learning from mistakes, and keeping your focus on the long term. Let's break down the key insights from this chapter. 1. J. Toma, From the Abyss to CNBC. Bellafiore introduces the concept of J. Toma, which stands for just the one more attempt. This idea comes from a trader's journey, where things may seem bleak and it feels like everything is falling apart. But, as Bellafiore explains, success in trading often comes after the toughest times. It's about picking yourself up from the abyss and never giving up. The story is about a trader who, despite suffering significant losses, stayed committed to his process and kept trying, believing that he just needed one more attempt to turn things around. Eventually, this resilience led him to be featured on CNBC, marking a complete turnaround in his career. Bellafiore emphasizes that trading is a marathon, not a sprint, and the most successful traders are those who can weather the storm when things aren't going well. Instead of getting discouraged by setbacks, keep your eyes on the bigger picture and remember that perseverance is key. The idea of J. Toma is a powerful reminder that success may only be one trade away. As long as you keep going, you increase the likelihood of finding that one more attempt that leads to success. 2. Don't focus on making predictions. Many new traders fall into the trap of thinking that they need to make perfect predictions about the market's direction in order to be successful. Bellafiore advises against this mindset. In trading, you're not trying to be a fortune teller. You're trying to identify opportunities and manage risk. The market is unpredictable, and no one can consistently forecast its moves with absolute certainty. Instead of focusing on making predictions, focus on your process, your strategy, and your ability to react to what the market is showing you in real time. Successful traders don't try to predict everything. They adapt to market conditions and stick to their plan. This mindset frees traders from the pressure of trying to be right all the time. Bellafiore emphasizes that focusing on the process is more important than focusing on outcomes. If you manage your trades well, the results will follow naturally. Trust your process rather than obsessing over making the perfect call every time. 3. You must believe. The final key point in this chapter is about belief. Bellafiore argues that in order to be a successful trader, you must believe in yourself and in your ability to succeed, even when things are tough. Belief isn't about blind confidence, but rather a trust in your skills, your strategy, and your ability to learn and improve. There will be times when the market goes against you, when you face losses, or when things just don't seem to be working out. But if you lose belief in yourself, you won't have the resilience to bounce back and keep going. Successful traders understand that belief is a cornerstone of their success. You must believe in the process and believe that as long as you continue to learn, adapt, and execute your strategy, you will ultimately succeed. Self-belief is a powerful tool that helps you stay motivated and committed to trading, especially through the tough times, where Bellafiore dives deeper into some critical lessons that can prevent traders from making significant mistakes. 1. Stopping yourself out, getting fired. One of the toughest lessons any trader will face is stopping yourself out, or essentially cutting your losses before they grow too large. Bellafiore compares this concept to getting fired. It might feel like a failure in the moment, but it's a necessary action to protect your capital and ensure you can live to trade another day. Many traders hesitate to stop themselves out because they don't want to admit they were wrong. They hold on to positions that are clearly losing, hoping for a reversal that may never come. However, this reluctance to act is one of the main reasons why traders get into serious financial trouble. The best traders are those who can cut losses quickly, not because they enjoy being wrong, but because they understand that it's a necessary step in their trading journey. Bellafiore emphasizes that stopping yourself out isn't about accepting defeat. It's about staying in the game. If you let a losing position run too long, you risk blowing your account and getting fired from the game entirely. In trading, protecting your capital is paramount. A trader who can't stop themselves out will never last in the game. Cutting losses quickly is one of the key habits that successful traders develop early on, and it's an essential skill to master. 2. Starting too quickly. Another mistake many traders make is starting too quickly. After doing some initial research or reading a few trading books, they may jump into the market without fully understanding the risks involved or without having a solid plan in place. This rush to start trading can lead to impulsive decisions and unnecessary losses. Bellafiore explains that starting slow and building experience is crucial for long-term success. Don't rush the process. Build a solid foundation by starting with small trades, practicing your strategy, and learning from your mistakes. Every trade, win or lose, should be seen as an opportunity to learn and improve. If you start too quickly and try to go for big gains right away, you'll likely make mistakes that could derail your progress. Starting slow also means taking the time to evaluate your trading strategy, your risk tolerance, and your overall approach. Patience is key. Remember, the market will always be there tomorrow, so there's no need to rush in. Successful traders are those who take the time to learn, develop, and execute their plans carefully without getting caught up in the desire for immediate results. Mar 3. Not everyone gets into Augusta. This is an interesting metaphor Bellafiore uses to remind traders that not everyone will make it to the very top. Augusta refers to the Augusta National Golf Club, home of the Masters, one of the most prestigious golf tournaments in the world. The point Bellafiore is making here is that not everyone is going to be a world-class trader, and that's okay. While it's important to aim for success, it's equally important to recognize that trading is a highly competitive field, and only a small percentage of traders will consistently reach the highest levels. However, this doesn't mean you can't be successful in your own right. Success in trading doesn't necessarily mean being the best trader in the world. It means developing a system that works for you, being consistent, and growing over time. Bellafiore stresses that you don't have to make millions or be at the top to be a successful trader. What matters is sustainable growth, sticking to your trading plan, and building your skill set every day. The important thing is to focus on your personal journey and continuously improve. Not everyone gets into Augusta, but that doesn't mean you can't find your own version of success by playing the game with discipline and patience. Welcome to Chapter 7 of One Good Trade, where we dive into the concept of stocks in play. In this chapter, Bellafiore emphasizes the importance of choosing the right stocks to trade and why understanding which stocks are in play can make or break your trading success. 1. What is a stock in play? A stock in play is a stock that is currently experiencing a high level of volatility and movement due to some sort of news, event, earnings report, or significant market catalyst. These stocks are the ones that attract attention from traders because they are actively trading with large price swings, offering opportunities for intraday profits. Bellafiore explains that these stocks often have unusual volume, meaning that they are seeing more shares traded than usual, and their price is moving in a dynamic way, which gives traders the chance to enter and exit positions quickly. It's not just about any stock, it's about stocks that are actively being traded, driven by something that moves the market, whether it's positive or negative news, earnings reports, merger rumors, or sector news. Stocks in play are typically short-term trades that can create big opportunities for traders who know how to react to the market's movements. Understanding which stocks are in play is a crucial skill for any trader, as these are the stocks that give you the chance to make profits during the day. 2. What is a good intraday stock? A good intraday stock is one that offers high volatility and liquidity while also aligning with your trading strategy. Bellafiore explains that the most successful intraday traders typically look for stocks that have a clear trend or momentum that they can follow throughout the day. These stocks usually have the following characteristics: high volume. Stocks that are actively traded, ensuring that you can easily enter and exit trades without slippage. Price movement. Stocks that show noticeable price swings during the day. These are the ones where you can take advantage of intraday price movements. Catalysts. Events or news driving the price action, whether it's an earnings announcement, an FDA approval, or even a sector-wide move. Clear trend or range. Stocks that are moving in one direction, up or down, or consolidating within a range offer clear trade opportunities. A good intraday stock should have all the right characteristics for quick, profitable trades. Bellafiore emphasizes that you want to focus on stocks where you can have a clear edge in timing your entry and exit. Timing is everything in intraday trading, and choosing the right stocks plays a significant role in that success. 3. Why trade stocks in play? So why should traders focus on stocks that are in play? Bellafiore answers this question by explaining that these stocks offer greater profit potential because they are volatile, which means larger price swings. When you're trading stocks in play, you can capitalize on these movements to make profits during the trading day. Another reason to focus on stocks in play is that they often have predictable patterns after a significant news event or catalyst. For example, after an earnings report, a stock might follow a certain pattern based on whether the news is good or bad. Traders who understand the reaction to such news can use it to their advantage by anticipating the next move. Stocks in play are also typically more liquid, which means easier execution of trades and lower transaction costs. Bellafiore explains that Momentum trading is all about recognizing when a stock has the potential to move fast, and stocks in play have that momentum. They provide traders with opportunities to enter at the right time and exit with profits before the trend reverses or the stock settles back down. Essentially, trading stocks in play gives you the best chance for a profitable intraday trade, especially if you know how to manage your risk effectively. 4. The importance of picking the right stocks. Choosing the right stocks is vital in achieving success in intraday trading. Bellafiore stresses that you shouldn't just trade any stock that shows up on your scanner. You need to pick the stocks that have the best setup and the most potential for profit. Selecting stocks that have good liquidity, volatility, and clear catalysts will provide you with more favorable odds of making a successful trade. The right stock is one that is aligned with your trading style. If you're a momentum trader, you'll want to focus on stocks with big price swings. If you're a trend follower, you'll want stocks with clear directional movement. But above all, picking the right stocks is about understanding which stocks are likely to give you the best opportunities based on your strategy and risk tolerance. Bellafiore reminds us that not every stock is worth trading. Even if a stock shows up on your scanner, you need to evaluate it carefully to see if it fits your criteria. If it doesn't, pass on it and wait for a better setup. By carefully selecting stocks that are in play and fit your strategy, you'll be in a better position to capitalize on profitable trades. Where Bellafiore addresses some critical concepts about black box algorithms, shortening the learning curve, and finding stocks in play. These points are incredibly important for any trader looking to gain an edge in the fast-paced world of trading. 1. Black box algorithms are nothing to fear. In the modern trading landscape, black box algorithms, also known as algorithmic trading, are a major part of the market structure. These algorithms use complex mathematical models to execute trades at high speeds, often without human intervention. Many traders may feel intimidated by the presence of these algorithms, but Bellafiore reassures us, they are nothing to fear. The key takeaway here is that while algorithms dominate certain parts of the market, they don't make trading impossible for the human trader. In fact, human traders can still outplay algorithms by using intuitive judgment, market knowledge, and strategic thinking. Bellafiore emphasizes that black box algorithms are often programmed to follow specific market trends and patterns, but they cannot react to unexpected, non-quantifiable events like humans can. For example, a human trader might recognize a change in market sentiment or a shift in news flow, which an algorithm may not be programmed to fully understand. Therefore, rather than seeing algorithms as a threat, view them as tools that can provide opportunities for those who know how to read the market. Active traders who use their intuition and market experience can still thrive in this algorithm-driven environment by leveraging insights that algorithms may miss. 2. Shortening the learning curve. The journey to becoming a successful trader is not easy, and it takes time. However, Bellafiore shares some insights on shortening the learning curve to help you accelerate your growth as a trader. The first step is practice, a key component of becoming proficient. Bellafiore explains that the more you immerse yourself in the markets, the faster you will learn. By observing price action, reading the news, and taking trades, you'll quickly become familiar with the patterns and behaviors that dictate how the market moves. Another important factor in shortening the learning curve is mentorship. Bellafiore stresses that learning from experienced traders can drastically speed up the process. Experienced traders can provide insightful feedback, share trading strategies, and help you avoid common pitfalls that could slow your progress. If you can find a mentor who has been through the same challenges, you'll be able to bypass many of the initial mistakes that new traders typically make. Finally, it's all about being strategic with your learning. Focus on the key areas of trading that will yield the most results, such as technical analysis, trade management, and market psychology. Bellafiore suggests that prioritizing the right lessons and continuously applying them to your trades will lead to faster improvement. Don't get bogged down by trying to learn everything at once. Master one concept at a time before moving on to the next. By focusing on consistent practice, learning from others, and strategic learning, you can shorten the learning curve and become a proficient trader much faster than you might have imagined. 3. Finding stocks in play. Finding stocks in play is an essential skill for any intraday trader, and Bellafiore provides a framework for identifying these stocks. Stocks in play are those that have significant news or market catalysts that are driving their price action. These could be stocks with earnings reports, merger news, FDA approvals, or any other event that will cause a surge in trading activity. But how do you find these stocks? Bellafiore recommends using screeners and stock scanners that allow you to filter for stocks with high volume, high volatility, and significant news catalysts. There are many free and paid tools available that help you identify stocks that are moving. Once you've filtered for stocks that are in play, the next step is to evaluate whether they fit your trading strategy. Some traders prefer to focus on stocks that are experiencing big price movements due to earnings, while others may prefer sector-wide shifts that affect an entire industry. The important thing is to choose stocks that align with your trading plan, ensuring that you can execute trades with confidence. Bellafiore also stresses the importance of monitoring stocks throughout the day to see how they react to the news. For example, after an earnings report, a stock may initially spike, but then consolidate or reverse. If you know how to read price action and understand the context behind the movement, you'll be in a much better position to identify high probability setups. Welcome to Chapter 8 of One Good Trade, where we dive into the world of reading the tape. If you've ever heard traders talk about tape reading or watching market depth in real time, this chapter is for you. Bellafiore gives us the tools to interpret the market's movements as it speaks through its price action. So, let's break it down and cover how you can start understanding what the market is telling you. 1. The tape talks to you. The concept of tape reading is an old-school approach to trading, and it refers to watching the market's price action and volume in real time. Before modern charting software, traders used to rely on the ticker tape to track price movements. The ticker tape would print out stock prices and volumes as trades occurred. Today, even though we use digital systems, the principle is the same. By observing how prices move, what volume is behind them, and how quickly changes happen, you can start to understand what the market is doing. Bellafiore emphasizes that the tape speaks to you in the form of price action. You can think of it as the market whispering clues about where it might be headed. Price ticks, speed of movement, and volume all combine to form a picture. The more you pay attention to these elements, the better you'll become at reading the market. Just like a musician can hear a melody, a seasoned trader can feel the rhythm of the market. By watching the tape, you begin to see patterns and develop a feel for momentum shifts, price rejection, and where the market is likely to go next. 2. I have a dream. Bellafiore takes a bit of a personal turn here, sharing his own experience with tape reading and how it became a crucial part of his success. He describes it as a dream that he had while learning to trade, a dream that involved watching the market's movements and seeing the price dance to its own rhythm. Over time, he learned to interpret these moves and predict the direction of the stock. It wasn't magic. It was a process of observation and learning. The more he watched, the more he could understand subtle shifts in price that were happening before the market as a whole reacted. By recognizing these shifts, Bellafiore was able to anticipate price movements, which gave him an edge in his trades. The dream Bellafiore speaks of is the ability to predict short-term price action based on the flow of the tape. It's not about guessing. It's about recognizing patterns and momentum that others might miss. Over time, with practice, you too can develop this ability to see the future movements in the market before they fully unfold. Shkar 3. A rip saved. In this section, Bellafiore shares a story about how reading the tape allowed him to avoid a major loss. He had a trade set up, but as he watched the tape, he realized that the momentum had shifted. The price action and volume indicated that the stock was likely to reverse course, And by recognizing this, he was able to quickly exit the trade, saving himself from a significant loss. This example is a key lesson in trade management. Being able to read the tape not only helps you enter the right trades, but also helps you exit wisely. The tape gives you clues about when a trade is no longer working, whether the price is reversing or the momentum is fading. The quicker you react to these changes, the better your ability to protect your profits and cut your losses. 4. Combat high-frequency trading. One common concern for traders today is the rise of high-frequency trade HFT, the use of powerful computers and algorithms to execute trades at incredibly fast speeds. It's easy to feel like these algorithms are leaving human traders in the dust. But Bellafiore reminds us that while HFT has its place, human traders still have an advantage when it comes to understanding context and market psychology. High-frequency trading is driven by speed, not necessarily understanding. HFT systems are programmed to react to price movements in milliseconds. However, they lack the ability to interpret news, economic events, or the emotion behind price moves. This is where human traders can thrive. By reading the tape and understanding the market's intent, you can get ahead of the algorithms. The key is to stay patient, react to shifts in the market, and avoid getting caught in the noise created by HFT. Bellafiore explains that while algorithms might be quick, they often operate in a reactive manner, whereas human traders can be more proactive, using their intuition and market knowledge. By recognizing the subtle signs of a trend reversal or momentum shift through the tape, you can outsmart the machines and take advantage of the opportunities they may miss. 5. Reading the Tape 101. Finally, Bellafiore dives into the fundamentals of tape reading, the basics of how to actually interpret the tape and what to look for when watching the market. He breaks it down into manageable steps so that traders can start incorporating this technique into their routine. Price ticks. Watch how the price moves in relation to time. Is it moving in a steady direction, or is it hesitating and bouncing? Price movement can give you an early indication of where the market might go next. Volume. Pay attention to volume because it tells you how much interest is behind the price movement. Strong price moves backed by heavy volume are more significant than moves on low volume. Speed of movement. Is the price moving quickly or slowly? Fast movements can signal momentum, while slower movements may indicate indecision or a potential reversal. Price rejection. Look for areas where the price fails to move past a certain level. This can be a sign that the market is rejecting higher or lower prices and could reverse. Bellafiore encourages traders to spend time each day watching the tape and learning how to interpret the market's messages. The more you practice, the more you'll begin to feel the market's movements and understand what's driving the action. It's about tuning into the market's rhythm and being able to predict where it might go next. He shares more valuable insights on adding more trading plays to your strategy, knowing when to load up, and how to approach chart reading. 1. Putting more trading plays in your quiver. As a trader, you want to have a variety of strategies at your disposal, just like an archer has different arrows in his quiver. Bellafiore emphasizes that the key to becoming a consistently successful trader is to have more trading plays that you're comfortable executing. By doing so, you increase the chances of finding high-probability setups in the market. A successful trader doesn't rely on just one type of trade. Bellafiore advises having multiple strategies ready for different market conditions, whether it's a breakout, a reversal, or a pullback trade. The more tools you have in your arsenal, the more adaptable you'll be when the market presents opportunities. But having more plays isn't just about casting a wider net. It's about developing expertise in each play. You want to be well-versed in different trade setups and know when they are likely to work. This comes from observing the markets, understanding your own trading style, and gaining experience over time. Incorporating a variety of plays into your trading strategy also helps you stay adaptable. Sometimes the market environment might favor one play over another, And by having different plays ready, you can quickly switch gears and take advantage of what's happening in real time. 2. When and where to load up and still limit your risk. Knowing when to load up on a trade, when to put on a larger position, is an essential skill for a trader. Bellafiore stresses that it's important to increase your position size when you have high confidence in the setup, but at the same time, you must limit your risk. There are specific moments in the market when it makes sense to go bigger. For example, when you have a strong trend in place, high volume, and clear price action. Those are the moments where you might consider increasing your size. The market has given you a clear signal that it's likely to move in your favor. However, the key to being successful with this is managing your risk. Bellafiore reminds us that even if you have high confidence, no one trade is guaranteed. Therefore, you should always have a stop loss in place and ensure that your risk-to-reward ratio is favorable. It's about knowing where you are willing to be wrong and setting your stop to protect your capital. Load up, but do it with a plan. Be sure you are taking calculated risks, and you always know how much you're willing to lose in case things don't go your way. 3. A love affair with charts. Now let's talk about charts. Bellafiore describes a love affair with charts, and it's not just about seeing pretty lines on a screen. A chart is one of the most powerful tools a trader can have in their toolkit. It gives you the visual representation of price action and allows you to interpret the market's behavior in a much more intuitive way. Charts help you identify trends, support and resistance levels, and key price action patterns. Bellafiore encourages traders to spend time learning how to read charts properly because they provide valuable insights into the market psychology behind each price movement. Whether you're using candlestick patterns, moving averages, or trend lines, charts help you visualize where the market might be headed next. The important point here is that charts should not be relied on in isolation. Instead, they should be used in conjunction with tape reading. By combining the data from the tape with the patterns on the charts, you can make more informed and confident decisions. 4. How do I read the tape? This section is where Bellafiore goes into more detail on how to actually read the tape. It's an essential skill for any trader who wants to understand the market's movements in real time. Reading the tape involves tracking real-time price action and trade volume to understand what's happening under the surface. Bellafiore provides a breakdown of how to interpret key aspects. Price action. Pay attention to how price moves on the tape. Is it moving in a steady direction, or is it stalling? The speed at which the price changes can give you valuable clues about the strength or weakness of the trend. For example, if a stock is moving quickly in one direction with high volume, it suggests strong momentum. Volume. Watch for spikes in volume, as this usually indicates that big players are entering or exiting the market. If you see a large move on low volume, be cautious. It may not have the sustainability to continue. Ticks, price ticks. The movement of price in small increments are important. For instance, a tick up followed by a tick down could indicate a false breakout or reversal. Conversely, multiple ticks in the same direction could signal the start of a strong trend. Speed of movement. Is the stock moving quickly or slowly? Rapid movements can indicate favorable conditions for short-term trades, while slower price movements might suggest consolidation or indecision in the market. Bellafiore stresses the importance of experience in learning to read the tape. The more you practice, the better you'll get at identifying the tells in the market, the small clues that indicate the next move. But the key is not to overthink it. Sometimes the tape doesn't tell you everything. But the more you pay attention, the more you'll begin to pick up on the subtle shifts that others might miss. Let's dive into Chapter 9 of One Good Trade, where Bellafiore discusses how to maximize profits and set yourself up for long-term trading success. This chapter is packed with insights on managing risks, making the right trades at the right time, and understanding the importance of consistency in your trading. 1. Setting your maximum intraday trading loss. The first key principle discussed is risk management. specifically setting a maximum intraday trading loss. Bellafiore stresses the importance of protecting your capital. Every trader needs to define a clear loss limit for the day. This is essentially the amount you are willing to lose before you stop trading for the day, no matter what. Why is this so important? Because it prevents emotional overtrading and ensures that one bad day doesn't erase all of your hard-earned profits. Once you hit your loss limit, it's time to step away. This isn't about being weak or giving up. It's about knowing when to protect your equity. Limiting your losses is a huge part of long-term success. If you keep trading after hitting your loss limit, chances are you'll be making emotional decisions, which rarely work in your favor. 2. Trading based on the time of day. Another key point Bellafiore makes is that timing is crucial when it comes to intraday trading. The markets behave differently at various times of the day. The first hour of trading is typically the most volatile. Many traders will have their positions set by the market open, which can cause sudden price fluctuations. Bellafiore suggests focusing on trades when the market is most favorable. For instance, the late morning to early afternoon tends to be a more stable time to trade. This period is where momentum shifts can be observed and where prices might settle into clear trends. By understanding the market's patterns throughout the day, you can identify more optimal times to make trades. The second half of the trading day often provides opportunities for positioning that didn't materialize earlier in the day. It's all about being strategic and not trading on autopilot. 3. Consistency. Consistency is one of the most important factors in becoming a successful trader. Bellafiore emphasizes that being consistently profitable is far better than having the occasional big win followed by a series of losses. Consistency in your approach, risk management, and discipline is what builds long-term success. You should aim to be consistent in how you trade, how you manage risk, and how you react to the market. Developing a consistent trading plan that you follow every day is crucial. Even on days when the market seems unpredictable, sticking to your plan can make all the difference. Remember, consistency doesn't mean that you'll win every trade, but it means you can manage your trades effectively and weather the ups and downs without letting emotions take control. 4. Proper sizing. Proper sizing of your trades is another topic Bellafiore discusses. It's not about taking huge positions or trying to make large profits on a single trade. Instead, it's about sizing your trades appropriately for your account size and risk tolerance. Proper sizing allows you to manage your risk while still having the potential for solid returns. Bellafiore advises that you should never risk too much on any single trade. As a rule, no more than 1 to 2% of your account balance should be at risk per trade. This ensures that even if you hit a series of losses, your capital remains intact. Another important aspect of sizing is the volatility of the stock you are trading. For stocks that are highly volatile, you may want to reduce your position size to mitigate the risk of sudden price swings. 5. Why comparisons can be harmful. Bellafiore warns that comparing yourself to others can be detrimental to your trading psychology. Every trader has their own unique approach, risk tolerance, and experience level. When you compare yourself to other traders, you might find yourself chasing after their results, which can lead to poor decision-making. Focusing on your own performance and progress rather than someone else's will keep you grounded. The goal isn't to be better than someone else. It's to be better than your previous self. The only competition you need is with yourself. Additionally, comparing yourself to others can lead to envy or self-doubt, which can cloud your judgment. Stick to your strategy, trust your process, and stay focused on your long-term goals. 6. Be mentally agile. Finally, Bellafiore emphasizes the need to be mentally agile. This means being able to adapt quickly to changing market conditions. The market is constantly evolving, and as a trader, you must be able to pivot when necessary. Mental agility also means having the ability to bounce back after a loss or a setback. Successful traders don't dwell on their mistakes or losses. They quickly move on and learn from them. Being mentally agile also involves staying calm and not letting emotions cloud your judgment. In the fast-paced world of trading, emotions like fear or greed can lead to impulsive decisions. But if you maintain mental clarity and remain agile, you can execute trades based on logic and strategy rather than emotion. Bellafiore dives into crucial points about staying persistent, developing trading plans, and dealing with slumps. These lessons will help you navigate through tough trading times and stay on track for long-term success. 1. Stay with it. It may take time to get on the right side of a trade. Bellafiore stresses that patience is key when it comes to trading. Sometimes it takes time to get into the right position and the right trade. Not every trade will work out immediately or as expected. In fact, the market is constantly shifting, and it might take a bit of time to find the sweet spot where your trade aligns with the overall market conditions. The takeaway here is to not give up too soon. You must stay with it, even if the trade doesn't go in your favor at first. The most successful traders are the ones who are persistent and stick to their strategies, even when the market doesn't immediately reward them. That said, it's important to remember that timing is everything. If a trade is not working, don't hesitate to cut your losses and adjust. But if you see a trade showing potential, be patient and let it play out. Ma 2. Developing if-then statements. One of the most effective tools that Bellafiore introduces in this chapter is the concept of if-then statements. These are essentially predetermined plans that you set for yourself before entering a trade. For example, if the price breaks above resistance with high volume, then I will enter a long position. If the price drops below support and shows signs of reversal, then I will enter a short position. These statements take the guesswork out of trading. By having a clear plan based on specific conditions, you eliminate emotions from the process and make your decisions based on logic and objective criteria. This strategy also helps you develop a more systematic approach to your trades and stay focused on the process, rather than reacting impulsively to price action. The more detailed and specific you can make your if-then statements, the better. By preparing in advance, you know exactly what to do when certain conditions are met, reducing the chances of hesitation or mistakes. 3. Knowing your best trading plays. As Bellafiore has already mentioned in previous chapters, it's important to focus on your strengths. Every trader has certain strategies or trading setups that they perform better at. For example, you might be particularly good at spotting breakouts or trend reversals. By identifying your best trading plays, you can hone in on the types of trades that align with your strengths and minimize the ones where you struggle. Trading is all about finding what works for you, and Bellafiore encourages you to double down on those strategies that have proven successful in the past. This might require some self-reflection and back-testing of your past trades to figure out what has consistently worked. Once you know your best plays, make sure to focus on them and perfect your execution. 4. How to end a trading slump. Every trader faces slumps. It's inevitable, but the key is how you handle them. Bellafiore gives some actionable advice for getting out of a slump and getting back on track. Here's the first rule: don't panic. A trading slump can feel like a never-ending series of bad decisions, but panicking will only make things worse. The best thing you can do is to step back and assess your situation with a clear mind. Cut back on risk during a slump. Lowering your position size or even taking a break can help you regain focus. Bellafiore recommends revisiting your trading journal and reviewing your past winning trades. Reflecting on what went well in the past can help you get back into the right mindset. Lastly, avoid the temptation to overtrade during a slump. It's easy to try to make up for losses by taking excessive trades, but this is a surefire way to dig yourself deeper. Instead, focus on quality over quantity and gradually rebuild your confidence and consistency. 5. The cheetah and the trader. Bellafiore wraps up Chapter 9 with a powerful analogy between the cheetah and the trader. The cheetah is the fastest animal on land, but it's not always in a constant sprint. Instead, it conserves energy and waits for the right moment to strike. As a trader, you need to channel your inner cheetah. Be patient and wait for the ideal setup. Don't rush into trades just because you feel the need to be active. The best traders are those who can wait for the perfect moment to make their move and then execute with precision when the conditions align. It's about quality and timing, not just sheer speed or quantity. The cheetah only sprints when it's certain it can catch its prey. Similarly, you should only go all in when you have a high conviction trade and everything is aligned. Let's dive into Chapter 10 of One Good Trade, where Bellafiore explores the importance of continuous education for traders. In this chapter, the focus is on developing your skills through review, mentorship, and learning from other successful traders. 1. Using video to review trades. One of the best ways to improve as a trader is by reviewing your own trades. Bellafiore emphasizes the value of video analysis in refining your trading skills. He suggests recording your trading sessions and then reviewing them in detail afterward. Why video? When you record your trades, you get to see your decision-making process unfold in real time. This gives you the ability to analyze your actions and emotions during the trade and learn from both the good and bad choices you made. It's like having a personal coach who can replay your actions and point out areas for improvement. For example, were there moments of hesitation before you entered a position? Did you stick to your plan, or did emotions take over? By regularly reviewing your trades, you can spot patterns in your behavior and refine your strategy to avoid repeating mistakes. Bellafiore suggests that you watch your videos with a critical eye and ask yourself questions like, did I follow my trading plan? How did I react when the trade moved against me? What could I have done differently? By identifying your weaknesses and strengths in your trade execution, you'll accelerate your learning curve and be more prepared for future trades. 2. Practicing techniques from top trading psychologists. In trading, psychology plays a huge role in your success or failure. Bellafiore highlights that the most successful traders not only have strong technical skills, but also strong mental resilience. Trading is stressful, and maintaining control of your emotions is often the key difference between a profitable trader and one who struggles. Bellafiore recommends learning from the best in the field when it comes to trading psychology. He advises studying techniques from top psychologists who specialize in the mindset of traders. Mental discipline, emotional control, and focus are crucial traits that any trader can develop over time. Techniques such as visualization, deep breathing, and cognitive reframing can help you manage stress, stay calm in high-pressure situations, and maintain a clear mindset when the market isn't behaving as expected. These mental tools are just as important as any technical skill because without the right mindset, even the best strategies will fail. By practicing these psychological techniques, you'll be able to handle setbacks better, make clear decisions, and avoid emotional trading. Bellafiore stresses that psychology is not something you learn once and forget. It's an ongoing process of improvement. 3. Mentoring. One of the fastest ways to improve your trading is to find a mentor. Bellafiore believes that mentorship plays a crucial role in the development of successful traders. Having a mentor can provide you with personalized insights, help you stay focused on your goals, and keep you on the right track when things get tough. A mentor can help you avoid common mistakes, refine your strategy, and provide you with constructive feedback. They can also offer you a different perspective on the market, which can be incredibly valuable when you're too caught up in your own trading patterns. Mentors offer more than just advice. They can guide you through difficult trading periods, provide emotional support, and help you stay motivated when you feel like giving up. Bellafiore encourages traders to seek out mentors who are experienced, patient, and knowledgeable, as they can make a world of difference in your trading journey. 4. Learning from traders on the desk. Bellafiore also discusses the power of learning from your peers, specifically traders who are on the trading desk with you. One of the best ways to improve as a trader is to watch others and learn from their experiences. Traders on the desk are usually in close proximity to one another, which allows for immediate feedback and the ability to exchange ideas. If you're trading in a firm or with a group, use this environment to your advantage. Watch how other traders react to market conditions, how they execute their trades, and how they manage their risk. By observing others, you can identify effective techniques and strategies that you might not have thought of yourself. Whether they're using a unique approach to technical analysis or managing their emotions better, there's always something to learn. Also, asking questions and engaging in conversations with your fellow traders can help you stay up to date with market developments and trading techniques. The key is to remain open-minded and be willing to learn from everyone around you, whether they're a seasoned trader or a newcomer. Where Bellafiore delves into the importance of enforcing trading rules, the environment on the prop desk, and innovative training methods to make traders more effective. 1. And yes, we do have deeper pockets. One of the advantages of being part of a proprietary trading firm or prop desk is the fact that you often have access to greater capital. Bellafiore touches on the benefit of having deep pockets, as this allows traders to take on larger positions and manage more risk than they could on their own. However, while having more capital may provide more opportunities, Bellafiore also highlights that this comes with more responsibility. Traders are expected to make wise decisions, manage their risk appropriately, and not waste the firm's resources. Having deep pockets doesn't mean you can be reckless. It's about leveraging that capital to your advantage while maintaining discipline and a strong risk management framework. For firms, it's a balance between giving traders the freedom to take on larger trades while also ensuring that the traders are educated and focused enough to handle that responsibility. The more capital you have at your disposal, greater the accountability to make profitable trades without getting too greedy. 2. Enforcing trading rules. One of the cornerstones of successful proprietary trading is having strict rules in place to protect traders and the firm against excessive risk-taking and emotional decisions. Bellafiore emphasizes the importance of enforcing trading rules for all traders, regardless of their experience level. Trading rules are there to keep traders grounded and disciplined. They help traders avoid emotional decisions and impulsive actions. These rules cover aspects such as position sizing, how much of a stock or asset you can buy or sell, risk limits, how much of a loss you're allowed to take before exiting a trade, trade setup criteria, clear conditions for when to enter and exit a trade. A good firm will constantly enforce these rules, ensuring that traders don't deviate from their plans or strategies. Consistent enforcement of these rules is essential for long-term success. Without them, traders might get too confident after a series of wins or too emotional after a loss, leading to poor decision-making. Bellafiore makes it clear that when rules are enforced, traders feel protected and can focus on the market without constantly worrying about making rash decisions. Moreover, accountability encourages better discipline and improves traders' ability to stay consistent. 3. The banter on the prop desk. One of the most unique and engaging aspects of trading in a prop firm is the environment on the trading desk. The banter among traders can be a valuable part of the learning process. On a trading desk, traders often talk shop, share insights, and discuss the market, creating a vibrant and intellectually stimulating atmosphere. Bellafiore describes the banter on the desk as a mixture of learning, competition, and support. In this environment, traders can pick up valuable lessons from their peers, ask questions, and learn from each other's mistakes. The open exchange of ideas helps traders sharpen their skills and think critically about their trades. That said, the banter isn't just about trading tactics. It's about creating a community of like-minded individuals who are all focused on improving and succeeding. The energy and camaraderie on a desk help keep morale high, and the collaborative nature of the environment means that traders can push each other to be better. For new traders, this type of environment can be a great way to quickly learn from others and feel supported in their journey. Even experienced traders benefit from the occasional exchange of ideas or perspectives that they might not have considered themselves. 4. Compiling trader statistics. In order to help traders improve, it's crucial to keep track of their performance metrics. Bellafiore explains that compiling trader statistics is essential for understanding what works and what doesn't in your trading. By keeping a record of each trader's successes and failures, you can identify trends, strengths, and areas that need improvement. Trader statistics typically include data on win rate, the percentage of profitable trades, risk-reward ratio, how much you're risking for the potential reward, average gain-loss, how much you're making or losing per trade, consistency, whether you're consistently following your strategy or deviating from it. By having these statistics readily available, traders can self-assess and see how their performance evolves over time. This data also helps traders adjust their strategies if needed. If a trader is consistently making small losses, for example, the firm can intervene and offer guidance. If they're consistently making huge profits, the firm might encourage them to take on slightly more risk to capitalize on opportunities. Collecting and analyzing these statistics helps both traders and the firm make more informed decisions, ultimately improving everyone's performance in the long run. 5. Secret Project X: Finding Cutting-Edge Ways to Train Traders Better. In the final part of Chapter 10, Bellafiore introduces a fascinating concept known as Project X, an ongoing effort to find new and innovative ways to train traders more effectively. Bellafiore is always looking for ways to optimize the training process and provide traders with the best resources to improve. Whether it's new simulation tools, psychological techniques, or better ways to review performance, Project X is all about finding the next big breakthrough in trading education. This drive for innovation helps firms stay ahead of the competition and ensure their traders have the best tools at their disposal. For individual traders, this means they should always be on the lookout for new opportunities to improve and expand their knowledge base, whether through new technologies or advanced training techniques. Bellafiore hints that Project X is about creating a dynamic, forward-thinking approach to trader development. It's a reminder that continuous improvement is the key to long-term success, and there's always more to learn in the world of trading. Chapter 11: The Best Teacher. In this chapter, Bellafiore focuses on the crucial role of education and mentorship in trading. According to him, the best teachers are those who are never satisfied, always looking for ways to improve both themselves and their students. Let's dive into the qualities that make up the best teacher and how they shape successful traders. 1. Never satisfied. The first trait of an exceptional teacher is being never satisfied. Bellafiore stresses that top traders and mentors are always in pursuit of more knowledge, more improvement, and more ways to get better. They are constantly evolving, seeking to perfect their craft and elevate their performance. This mindset of never settling is essential for both traders and teachers. For a trader, the path to success is not about finding a single right way to trade and sticking with it. It's about constant adaptation, learning from mistakes, and being open to growth. The best teachers understand this and pass this philosophy down to their students. The goal is to never stop growing, whether you're learning from a mentor or refining your own strategies. So, if you want to become a top trader, embrace the mindset that there's always more to learn. Perfection is a journey, not a destination. And the best teachers inspire this kind of thinking in their students, encouraging them to keep going and never stop trying to improve. 2. Highly motivated. A great teacher is highly motivated. Bellafiore notes that motivation is contagious, and a teacher's passion and drive can fuel a trader's own desire to succeed. The best teachers are not just knowledgeable, but fired up about what they do. They convey their energy and enthusiasm in every interaction with their students. This high level of motivation is what pushes traders to stay focused, to keep learning, and to never give up when times get tough. It helps traders overcome obstacles and keep their eyes on the goal, even when the market isn't in their favor. As a trader, you must also cultivate your own motivation. Find what drives you, what keeps you hungry for success, and let that energy guide you through the ups and downs of trading. The best teachers, Bellafiore says, are those who constantly show up with passion, and in turn, they inspire their students to do the same. 3. Communicate clearly. One of the most important aspects of being a great teacher is the ability to communicate clearly. Bellafiore emphasizes that teaching isn't just about knowing the material. It's about being able to break it down in a way that's understandable, accessible, and actionable. Great teachers take complex concepts and simplify them for their students, ensuring that the message is clear and easy to grasp. In the world of trading, this means helping students understand the strategies, the psychology, and the market mechanics without overwhelming them. As a trader, being able to communicate clearly is just as important. Whether you're explaining a trade to a mentor, discussing strategy with a colleague, or reviewing your trades with yourself, clear communication helps you make sense of the why behind your actions and decisions. 4. Builds on a firm foundation. The best teachers build on a firm foundation. They don't just toss advanced concepts at their students. Instead, they focus on strong fundamentals. Bellafiore points out that traders need a solid understanding of the basics before they can successfully implement more complex strategies. For instance, before jumping into intricate technical indicators, a trader needs to understand price action, market trends, and risk management. The same goes for learning new trading techniques. If you don't have a solid grasp of the fundamentals, you'll struggle to build upon them. The best teachers lay the groundwork for their students, ensuring they understand the core principles before advancing to the next level. This foundation is what keeps traders grounded, helping them navigate the challenges of the market with confidence. Including the new elements: 1. You say tomato, I say tomato. Bellafiore introduces the idea that different traders have different approaches and styles, just like the famous tomato versus tomato debate. What works for one trader may not work for another, and that's okay. The key is understanding your own style and being true to it. As a teacher or mentor, it's important to recognize that there's no one-size-fits-all approach to trading. A great teacher respects this diversity and helps students find their own way. For traders, this means understanding your strengths and weaknesses, then crafting a strategy that fits your personality and goals. So embrace your uniqueness as a trader, and don't feel pressured to follow someone else's path. The most important thing is to find what works best for you. 2. Looks inward. The best teachers don't just focus on what their students are doing wrong, they also look inward at themselves. Bellafiore emphasizes that a teacher's self-awareness is crucial for success. The most effective mentors are constantly self-reflecting, trying to improve not just their students, but themselves as well. For traders, this means looking at your own performance, identifying your mistakes, and learning from them. Instead of blaming external factors, great traders focus on their own behavior and mindset. In trading, self-awareness is a huge part of long-term success. It helps you stay level-headed and make better decisions, even when the market is volatile. So always take the time to look inward. Ask yourself, what can I improve? What mistakes did I make, and how can I avoid them next time? 3. Practices patience. Patience is another cornerstone of both teaching and trading. The best teachers know that learning takes time. They're not looking for instant results. They understand that true growth happens over time with consistent effort. For traders, patience is just as crucial. The market won't always give you immediate results, and not every trade will be a winner. But with patience, you'll allow yourself the time to learn from each experience and adjust your strategies. Patience also means not rushing into trades or trying to force opportunities when they aren't there. Great traders are patient. They wait for the right setup, and they stick to their well-crafted plans. They know that the best trades often come after careful consideration and time spent observing the market. So, don't be afraid to practice patience. It's not just about waiting. It's about knowing when to act and when to hold back. 4. Gets tough. In trading, things will inevitably get tough. Losses happen, markets turn against you, and not every trade will go your way. But the best teachers and traders don't shy away from these challenges. Instead, they embrace them and learn from them. Bellafiore notes that a great teacher is someone who helps students navigate tough times and turn adversity into a learning opportunity. For traders, this means having the mental toughness to bounce back from losses, learn from mistakes, and stay focused on your long-term goals. Resilience is key in this game. When the going gets tough, don't let emotions take over. Get tough. Learn to stay calm under pressure, stick to your plan, and keep moving forward. Overcoming setbacks will build your strength as a trader and as a person. 5. Sacrifices. Bellafiore emphasizes that to become a great trader, you have to be willing to make sacrifices. This could mean sacrificing your time, your comfort zone, or even your social life in the short term in order to grow your skills and improve your trading. The best teachers and traders understand that success doesn't come without sacrifice, but these sacrifices are worth it, as they pave the way for long-term rewards. As a trader, you must be willing to put in the hours, dedicate yourself to the craft, and commit fully to becoming better. Are you ready to make sacrifices for your trading journey? The most successful traders don't take shortcuts. They invest in their growth and make smart choices along the way. 6. Set firm values. Finally, the best teachers and traders set firm values. Bellafiore stresses that it's not just about technique and skills. It's also about ethics, integrity, and sticking to your core principles. The best traders don't let greed, impatience, or fear drive their decisions. Instead, they trade with discipline and follow rules that align with their values. As a trader, setting firm values means having a clear trading plan, sticking to your risk management rules, and not letting emotions take over. It's about respecting the market and trading with integrity. Set your values early and let them guide you. Stick to them, no matter the temptation or pressure. In the long run, your values will be what separates you from others and ensures that you remain on the path to success. Chapter 12. Adapt to the markets. In this chapter, Bellafiore emphasizes that to succeed as a trader, you must adapt to the ever-changing landscape of the market. He takes us through significant historical events that shook the financial world, showing how market cycles can dramatically impact trading and why it's crucial to stay flexible in your approach. 1. The Asian Financial Crisis. The Asian financial crisis of the late 1990s was a pivotal moment in global trading. It highlighted just how vulnerable markets can be to unexpected events. The crisis started in Thailand and quickly spread to other Asian nations, destabilizing economies worldwide. This event caused significant market volatility, affecting everything from currency values to stock prices. For traders, this was a crucial lesson in understanding that markets don't operate in a vacuum. They are interconnected, and a crisis in one region can cause ripple effects around the world. As a trader, adapting to these kinds of shocks is essential. You must be able to read market signals, manage risk, and adjust your strategy accordingly. Bellafiore notes that reacting quickly to changes is often what separates successful traders from those who fall behind. It's about staying informed and adjusting your approach when market conditions suddenly change. In the face of such uncertainty, great traders don't panic. They adapt and evolve. 2. The Internet boom. Fast forward to the late 1990s and early 2000s, and we hit the Internet boom, a period when tech stocks, especially those related to the Internet, saw astronomical growth. The rise of companies like Amazon and Google transformed the market, and many traders found success by capitalizing on this wave of optimism surrounding new technologies. For traders, the Internet boom was a lesson in seizing opportunities during periods of market excitement. It was about identifying the right stocks at the right time and capitalizing on them as they surged in value. But Bellafiore also cautions that periods of extreme bullish sentiment can also lead to overvaluation and bubble-like conditions. As a trader, adapting to market cycles means understanding both the potential rewards and the risks. When the market is overly enthusiastic, it can lead to irrational behavior, which is why staying grounded and using your trading strategy to navigate these boom times is crucial. 3. The bounces of 2001. In the aftermath of the Internet boom, the market experienced significant bounces throughout 2001. After tech stocks took a dive, there were short-term recoveries known as bounces, where stocks would rebound temporarily before falling again. These market conditions provided traders with opportunities to capitalize on the up and down movements of the market. Bellafiore explains that these bounces were a reminder that trading isn't just about catching the big trend. It's about being able to spot smaller, short-term movements and taking advantage of them. Adaptability is key here. Traders who could adapt quickly to these bounces, entering and exiting the market at the right times, were able to profit, even when the long-term trend was bearish. For traders, it's important to remember that not every trade has to be a home run. Sometimes, smaller profits made consistently during volatile times can add up to significant gains. Recognizing these bounces and knowing when to ride the wave or when to step out of the way can make a world of difference. 4. 9/11. One of the most significant shocks to the financial world in the 21st century was the tragic events of 9/11. This global crisis changed everything about how the markets functioned. There was uncertainty, fear, and a sense of instability that took months, even years, to settle. For traders, the aftermath of 9/11 was a wake-up call in understanding the importance of risk management. With the markets closed for several days following the attacks, traders had to find ways to react to the massive uncertainty that followed. The event reinforced the need to be prepared for unexpected events that can cause markets to change abruptly. Bellafiore stresses that a key lesson here is flexibility. Great traders can adapt to uncertainty and adjust their positions to protect themselves from the unknown. When the world around you is shifting, being able to remain calm, focused, and strategic is critical. 5. A bearish cycle in the early 2000s. After the optimism of the internet boom and the shock of 9/11, the early 2000s saw a prolonged bearish cycle, especially in tech stocks. This period was marked by recessionary conditions, poor economic growth, and a market that was no longer buoyed by the same high levels of speculation. Traders had to adjust to a market that no longer offered the same level of excitement or opportunity. In this environment, patience and discipline became even more important. Instead of chasing after big gains, successful traders were focused on preserving capital and finding consistent smaller profits in a market that was increasingly difficult to navigate. Bellafiore points out that these periods of bear markets can be the most challenging, but also the most rewarding for those who are willing to stay patient and adapt their strategies. Traders who could remain disciplined in their approach were able to weather the storm and come out ahead when the market eventually recovered. 6. The spread of the penny. The chapter continues with an exploration of penny stocks and how they became more prevalent in the trading landscape. Penny stocks, which are low-priced and often considered high-risk, became popular during periods of market volatility and uncertainty. Bellafiore explains that penny stocks can offer high returns due to their low price, but they also come with significant volatility. Traders who are adaptable understand that these stocks move unpredictably, and it's important to approach them with extra caution. The key takeaway here is that patience and discipline remain essential. Penny stocks may seem like quick profits, but slow and steady wins the race. For traders, adapting to the rise of penny stocks means recognizing when these stocks are overhyped or when their movement is driven by actual market fundamentals. Strategic entry points and exit strategies are crucial when navigating this high-risk terrain. 7. Then came hybrid. Following the era of penny stocks, the trading environment evolved into what Bellafiore calls the hybrid market. This hybrid phase brought together the traditional floor trading with electronic trading systems, revolutionizing how stocks were bought and sold. In this hybrid environment, traders could execute faster, access more data, and make quicker decisions than ever before. However, this also introduced new complexities. The ability to adapt to the speed and complexity of hybrid trading became critical. Successful traders had to learn to balance the human aspects of trading, intuition, patience, and strategic thinking with the rapid execution capabilities of modern technology. Bellafiore advises traders to be technologically savvy, as the hybrid model combined human expertise with machine precision. The takeaway? Embrace technology, but don't forget the fundamental aspects of trading that make you successful: strategy, discipline, and risk management. 8. The uptrending market. The uptrending market refers to periods when the stock market experiences consistent growth, often driven by economic expansion or strong corporate earnings. During such times, stocks tend to rise, and many traders see substantial gains. Bellafiore talks about the psychological shift that happens in an uptrending market. As stocks keep going higher, traders might get more confident and even a bit complacent, assuming that the trend will never end. This is where risk management becomes especially important. When the market is uptrending, the temptation is to hold on to winners for too long or take on excessive risk in hopes of even greater profits. The lesson here is to stay grounded and avoid getting carried away by optimism. Even in a bull market, it's important to stick to your plan and manage your risk. Adaptation during this period means knowing when to take profits, limit losses, and avoid chasing prices. Next, Bellafiore dives into the 2008 housing crisis, which was a game changer for many traders. The housing bubble led to an economic meltdown, and markets were suddenly caught in a whirlwind of uncertainty and volatility. Many traders who had been riding high on the market's optimism faced massive losses when the housing market collapsed. Bellafiore emphasizes that understanding macroeconomic events and their impact on the market is essential. The housing crisis proved how interconnected different sectors and markets are. The collapse of the housing market triggered a domino effect, affecting banks, investors, and global markets. Traders had to quickly adapt to this new environment by recognizing new opportunities in different markets, managing risk more cautiously, and preparing for sharp declines in stocks. The key lesson is that economic events have far-reaching consequences, and as a trader, you must be able to pivot quickly when things start to shift. 10. The prices of oil and gas skyrocket. The chapter also touches on the period when oil and gas prices skyrocketed, especially in the mid-2000s. The surge in energy prices had a significant impact on the global economy, fueling inflation and impacting everything from consumer spending to corporate profits. For traders, the rise in oil and gas prices created both challenges and opportunities. On the one hand, higher oil prices could lead to rising costs for many industries, hurting stock prices. On the other hand, energy stocks and oil companies stood to benefit, providing traders with new opportunities in these sectors. Bellafiore underscores the importance of reading the market and understanding broader economic trends. Traders who could adapt to the changing price of oil and make smart moves in energy stocks were able to capitalize on the volatility. However, those who ignored the signs of rising prices were caught off guard. The takeaway is clear. Stay aware of global factors, like commodity prices, that can greatly influence market behavior. 11. The near collapse of the U.S. financial industry. The chapter continues with the near collapse of the U.S. financial industry during the 2008 financial crisis, which was one of the most significant, impactful events in recent trading history. The crisis was triggered by a combination of risky lending practices, the bursting of the housing bubble, and excessive risk-taking by financial institutions. Bellafiore describes how the collapse caused severe credit crunch, panic selling, and a dramatic reduction in liquidity across global markets. Many traders faced massive losses as stocks plummeted and volatility surged to unprecedented levels. The meltdown also led to the failure of large institutions like Lehman Brothers, and other financial giants like Bear Stearns and AIG were on the brink of collapse. The near collapse of the U.S. financial system created an atmosphere of fear and uncertainty. Bellafiore emphasizes how traders must be aware of systemic risks and understand that economic systems are sometimes more fragile than they appear. While some traders were devastated by the collapse, others recognized the opportunity in the chaos and were able to capitalize on the market's wild swings. The takeaway here is that macro events like financial crises can reshape the entire market landscape, and being able to adapt quickly, understand the bigger picture, and protect your capital is critical. 12. ETFs explode in popularity. The chapter then shifts focus to the rise of exchange-traded funds, ETFs, which exploded in popularity after the financial crisis. ETFs offer traders the ability to buy and sell a basket of securities, such as stocks or bonds, without having to purchase individual stocks. They are seen as a more efficient, cost-effective, and flexible way to trade across different sectors, industries, or asset classes. Bellafiore explains how ETFs provided a new tool for traders, especially in a volatile market. ETFs gave traders more diversification, allowing them to spread risk across multiple assets, which became even more valuable during the periods of heightened market uncertainty following the crisis. The explosive growth of ETFs also meant that traders had access to a wider variety of instruments, ranging from broad market ETFs to more niche sector-specific or thematic ETFs. This explosion in popularity also led to the development of specialized ETFs, which allowed traders to focus on specific industries, commodities, or market strategies. Traders who adapted to the rise of ETFs were able to capitalize on a new trading vehicle that offered advantages in terms of liquidity, flexibility, and risk management. For those who embraced ETFs early on, they became an essential part of their trading toolkit. 13. Trades to hold. The final section of Chapter 12 introduces the concept of trades to hold, a strategy for traders who want to extend the duration of their trades beyond the typical intraday moves. Unlike traders who exit positions within minutes or hours, the trades to hold strategy involves taking positions with a longer-term outlook, sometimes holding them for days or even weeks. Bellafiore explains that trades to hold requires a different mindset than typical day trading. Traders using this strategy focus on high-quality setups and positions where the potential for profit over a longer period outweighs the need for quick exits. It also requires a more patient approach, as traders must be willing to ride through market fluctuations and avoid getting shaken out of their positions by short-term market noise. The key to trades to hold is discipline. Traders need to know when to enter a position with conviction and when to exit after achieving their profit goals. They also need to be prepared for the emotional toll of holding positions for an extended time. The ability to stick to a well-thought-out plan and resist the temptation to exit too soon or hold on too long is crucial. Bellafiore advises that this approach should be reserved for specific situations where the market conditions support it, and the trader has a clear understanding of the potential risks. It's not suitable for every trader, but when done correctly, trades to hold can be an effective way to capitalize on larger market moves. Chapter 13, The Successful Trader. In this chapter, Bellafiore explores the key traits and strategies that define successful traders, those who consistently make money in the market. He goes beyond just technical analysis and explores the mental and emotional traits that set top traders apart from the rest. Consistency is key. The first characteristic of a successful trader is the ability to be consistent. Bellafiore stresses that consistency is not about having one lucky big trade. It's about being able to consistently make profitable decisions over the long term. This means not getting too emotional or attached to one trade and focusing on making smart, well-executed trades that align with your strategy. Successful traders develop a plan and stick to it, regardless of market noise. They understand that consistent profit comes from maintaining discipline, following the plan, and managing risk at all times. They are always focused on improving, refining, and adapting their approach based on experience and data. 2. Embracing the process. Another key trait of successful traders is their focus on the process rather than just the profits. The best traders know that the path to success is built by following solid processes. Making sure their trading strategies, risk management techniques, and daily routines are all in place and functioning at the highest level. Bellafiore mentions how many traders fail because they focus too much on the outcome, the money they make or lose. The successful ones, on the other hand, focus on the process and how well they are executing it. If the process is right, profits will follow. The key is to trust the method and understand that short-term fluctuations are part of the game. 3. Patience and emotional control. Patience is another cornerstone of successful trading. Bellafiore highlights how the most profitable traders are able to wait for the perfect setup and then execute their trade with precision. They don't rush, they don't chase the market, and they don't feel the pressure to act just because the market is moving. Emotional control is also a huge part of this. The best traders don't let fear, greed, or frustration influence their decisions. Instead, they rely on their trading plan, the data, and their own disciplined decision-making process. They know when to stay in a trade and when to cut losses. Emotional stability enables traders to make level-headed decisions, especially in times of market volatility. Focus on the long term. Successful traders also have a long-term perspective. While many traders look for instant gratification, the most consistent ones look at trading as a marathon, not a sprint. Bellafiore emphasizes that long-term traders understand that it's not about hitting big home runs every day. It's about making consistent, small profits over time and compounding them. This mindset helps traders focus on making wise decisions day after day, rather than trying to capture every single opportunity. By focusing on the long term, they avoid getting distracted by the short-term ups and downs of the market. 5. Risk management and position sizing. A successful trader also knows how to manage risk. Bellafiore reiterates that no matter how good your strategy is, if you don't manage your risk effectively, you're bound to fail. Successful traders never risk more than they are willing to lose on any given trade. They understand how to set stop-loss orders, how to size their positions appropriately, and how to adjust their risk exposure depending on market conditions. Risk management isn't just about cutting losses. It's also about knowing how much to trade and when to scale in or out of a position. The best traders know that risk control is paramount, and it's the key to long-term survival in the markets. Never stop learning. Another trait of successful traders is their desire to learn. The best traders are constantly seeking new knowledge, refining their strategies, and staying updated on market conditions. They never assume they have learned it all. Bellafiore points out that top traders are always looking to improve, whether by reading books, analyzing past trades, or learning from other traders. They are open to feedback, and they embrace mistakes as learning opportunities. Each trade, whether a win or a loss, teaches them something valuable. Over time, they build up a repository of experience and lessons learned that make them better traders. Adaptability. Finally, successful traders are extremely adaptable. Bellafiore highlights that markets are constantly changing, and the ability to adjust to new information, new market conditions, and evolving strategies is essential. Traders who can adapt are the ones who can thrive in the face of uncertainty. Whether it's adapting to new technologies, changes in market structure, or shifts in economic conditions, the best traders are always able to adjust their strategies to meet the market's new demands. Their ability to stay flexible is a key factor in their long-term success. As we wrap up this journey through one good trade, Bellafiore has shown us that successful trading is far from just about making the right moves at the right time. It's about developing the right mindset, consistently following a structured process, and adapting to the market's ever-changing landscape. Through the chapters, we've learned that trading is a skill that requires discipline, patience, and a commitment to constant improvement. It's about mastering the basics, managing risk effectively, and understanding that failures along the way are just stepping stones to success. Whether it's mastering your emotions, learning from your mistakes, or developing a clear trading plan, each step is part of a bigger journey towards becoming a successful trader. The best traders are not the ones who make the most money in the shortest time, but those who stay consistent, adapt to the market, and focus on long-term success. By always refining your skills, maintaining a clear vision, and learning from both your successes and failures, you too can follow in the footsteps of the greatest traders. So remember, trading is about the journey, not just the destination. Keep improving, stay disciplined, and most importantly, keep trading smarter. If you found these insights valuable, make sure to like, share, and subscribe for more engaging content on trading and personal development. See you in the next one.